If you own a strata property and your insurance premiums have gone up this year, then today's video may help you understand the why behind that increase. Welcome back to the channel and thanks for being here. While you may not know that I'm a licensed real estate agent in the province of BC, you will have likely heard the many reports of increased insurance premiums that many strata corporations have faced all year. If you are from another part of Canada, you are likely faced with the same premium increases. However, you may refer to them as condominium corporations or HOAs. As I said, I'm a licensed real estate agent, not an insurance broker, so consult with your local professional for specifics. A recent article in the Vancouver Sun detailed a little-known policy that is used throughout the insurance industry known as best terms pricing. And unfortunately, based on a recent report by BC Financial Services Authority, when looking at the insurance renewals of 500 strata corporations, best terms pricing was in effect 95% of the time. So what exactly is best terms pricing? First, I'm not trying to say that this is the only reason for the increased rates this year, but it will become quite clear to see how it could have a large impact. Next, to explain best terms, I need to explain how the insurance policy of your strata corporation is formed. For this, I'll use a real-world scenario that recently came across my desk. The strata corporation in question is 2 years old, comprised of a little over 100 units, and has an insured value of $40 million. The BC Strata Act requires that strata corporations maintain full coverage over their properties. However, very few, if any, insurance companies are interested in covering $40 million on one property by themselves. For this reason, the insurance policy is covered by more than one company. In this particular case, a total of 9 insurance companies were required to satisfy the 100% coverage requirement. However, the coverage of each individual policy ranged from 2.5% to 17.5% of the total value. The insurance policy was billed at a total charge of $214,000, which provides an average insurance rate of roughly 53 cents per $100 of coverage. But that's an average. So let me explain now how best terms pricing could come into effect. Each of the 9 companies will have submitted their bid for the amount of coverage they are prepared to offer. Perhaps their bids range from 40 cents per $100 covered to 53 cents. Regardless of what amount of actual coverage being offered, the company that offered the 53 cents has now set the rate that the remaining companies will be paid. That is, the other companies that bid lower don't charge their fees based on their bid, they now charge based on what the highest bidder was actually charging. This means that while a company may have only offered to cover 2.5% of the policy, they have effectively set the price for the entire policy, and it is now a lot higher. Now, there have been suggestions that an average rate of the bid submitted actually be used. However, this can have an adverse effect, in particular if the lowest rate that is bid is also responsible for the highest coverage amount. Clearly, this is not the only variable when deciding insurance prices. However, it simply highlights a system that has little to no transparency. So what do? I realize there are many factors at play that could prevent getting rid of best terms pricing. And quite honestly, I think the first step is truly just understanding what those factors might actually be. In order for that to happen, I have a couple of suggestions to improve the transparency that I think is lacking. Number 1. Require that all insurance policies state the company's original bid along with their adjusted bid amount if it's different. Number 2, require insurers to cover at least 5 or even 10% of a policy. It doesn't make much sense that an insurer carrying only 2.5% of a policy can set the rate for the entire thing. Number 3, require insurance brokers to disclose where their commissions come from and the rates that each insurer within a complete policy are actually paying. As a real estate agent, I'm required to be transparent about where any payment comes from and the method of the calculation. Yet I didn't see anywhere on this policy that broke down how the insurance broker was being paid and who was paying it. Number 4, I'll be totally honest here, I'm not 100% sure of how the claims process works, which may be a product of the system or simply a hole in my knowledge. However, I also think there should be a priority order for claims. For example, if you have 9 companies in line, but you have a claim that only requires 30% of the insured value, there should be a pecking order. Company number 9 would therefore have much less risk associated with their coverage and may adjust their rates accordingly. Number 5, On a real estate level, I also believe that insurance claims history and information should be provided as part of regular documents when involving the sale of a property. Currently, as part of the review of the Strata documents, including minutes and bylaws, a copy of the insurance certificate is the only item provided, as the Strata Corporation or the management company are not actually required to provide any claims history. I'll put links to the article and the spreadsheet that I referenced in today's video. And that's it for me for today. If you found today's video helpful and informative, hit the like button to let me know and click subscribe so you don't miss any future videos. If you have any questions or feedback, put them in the comments section below and I'll try to get back to you. As always, thanks for watching and have yourself a great day.